On Sunday, February 22nd, a research report hit social media and it absolutely rocked the way that people are thinking about, or accelerated the way that people are thinking about the destruction that could be coming in the economy because of AI. So, what was this report and how serious should we take it? My name is Brian Stoffel, and we're going to spend the next couple of minutes trying to figure this out. Now, first of all, the report was written by Citrini Research, and it is worth saying that it is an excellent piece of writing. It is also intended to be a warning. It is not Citrini's attempt at creating a bear situation. I would say rather, what I'm about to cover was intended to be a warning to encourage people to think about the ways that they're approaching investing in business heading into the age of AI, and especially agentic AI. And as you can see, this just dropped on Sunday afternoon, and as of the time of this recording, less than 2 days later, already has over 25 million views. So what did this research say? In general, it talked about the unwind of what it calls the intelligence premium. Now, here's what this basically means. For centuries, human intelligence was a scarce input, and this makes sense. It's why people who are really smart and are able to do powerful things are paid high salaries. But AI has made intelligence abundant. And so our financial system, from mortgages, colleges, degrees, career paths, they were all built upon this assumption that our labor has value. And what Citrini's research report argues is that that is now being repriced. And the way that this was written is it assumes that the piece was written in 2028, specifically June 2028. And it talks about how we find ourselves in a really terrible time. And what do we mean by that? Well, it says unemployment has gone above 10%. The S&P 500 is down 38% from its high. We've had a consumption collapse, and yet it's called a ghost era of ghost GDP, where it's an economic pandemic and not a panacea, even though that blue line is going up because corporate profits and AI compute spend is doing great. It's only accruing to the very few people who work at or own shares at a very few number of companies, whereas the rest of us, real wage growth and the velocity of money has cratered. So how does Citrini say we will get there? Let's rewind the clock to today and go over what the timeline is that they offer forward. So it starts right around today, early to mid 2026. And the big assumption here is that AI keeps getting better. Now, it's not hard to see that this is the case. I myself didn't use Gemini at all 6 months ago because I wasn't very impressed with its functionality. But when the most recent version came out, I now spend hours every day on Gemini, and every week it gets better. So I think that this is true. And in the report, they made a really good point. They said, this is the money quote, a single GPU cluster in North Dakota can generate the output previously attributed to 10,000 white-collar workers in Midtown Manhattan. So I don't think we'll have a ton of people arguing that AI is improving at an almost exponential rate. That leads us to the second part, which gets us out of the current moment and into the future, where Citrini argues by late 2026, software as a service companies are going to lose their pricing power permanently. They're not saying that legacy enterprise SaaS companies are going to lose their existing customers, because the case has been made, and it has merit, that there are still huge switching costs with abandoning something that is installed and is the guts of a company's standard operating procedure. However, the money quote here was, in late 2026, SaaS wasn't dead. There was still a cost-benefit analysis to running and supporting an in-house build. But in-house builds were an option, and that factored into pricing negotiations. And if you know anything about discounted cash flow analysis when it comes to valuing these companies, if you permanently impair the terminal growth rate of any company, that will permanently change the valuation of those stocks. So this is saying that, sure, these companies might not lose their big existing customers, but the fact that their moats are starting to crumble means that the valuations are going to start to reflect that. We've already seen this start to happen, but they're just saying that the evidence of it happening will really be becoming clear by late 2026. And that makes sense because most SaaS companies, their headline numbers are still very, very good. The next step comes in early 2027 when the disruption goes beyond just SaaS. And here's how Citrini said this would happen. This is the key point. Humans don't have time to price match across 5 competing platforms to, for instance, buy a box of protein bars. But machines do, and your own AI agents do as well. What could this disrupt beyond just SaaS? Well, Citrini argues it could disrupt travel booking, real estate, financial advice and tax preparation, aggregators like DoorDash and Uber, insurance companies that are reliant upon you just renewing your policy, and even credit cards. Here's how it says it does that. Many companies, it says, they rely on friction, but the end of the lazy tax and brand loyalty is on its way, it argues. Now, the way that it says that commerce usually works today is we don't have a linear path to making these decisions. Because we're humans, we use brand familiarity, confusion, lazy purchase, habit to make these purchases, and companies rely on that and get high margins for it. But if we turn these decisions over to agents to make these decisions that can run continuously, they think in a straight line. They think about what's the objective need of the human I'm serving. They will globally scrape for prices. They will have a 200 millisecond negotiation, and that will bring margins down for many companies. And as I said, it can be make casualties of aggregators, travel bookers, insurance brokers. Basically, the habitual app loyalty doesn't exist when machines are the ones making these decisions. Which leads us to late 2027, where Citrini argues that the labor market is going to shift. We've got a lot of these $180,000 product managers for software companies and others in those industries we just talked about that are losing their jobs. They will trickle down into the service and gig economy, leading to more trickle down into structural unemployment, leading to large jobless claims. And this is an important fact to remember when we think about, well, okay, we're just talking about white collar jobs. What about all the others like plumbers, like electricians? Here's the thing that you still need to remember. Citrini points out that white collar workers are roughly 50% of the workforce. However, they represent 75% of consumer discretionary spending. So when that consumer discretionary spending starts coming down and those in the service and gig economy lose their pricing power, well, then that can spell real trouble for the economy writ large, which brings us to where this report was purportedly written in June 2028. And a lot of correlated bets start to fall because this first domino is falling. For instance, it talks about how private equity made large investments in software as a service companies, whether it was taking out loans to buy out software as a service companies like Zendesk, which is really becoming somewhat not needed in the age of agentic AI, or they offered loans to SaaS companies. The real problem comes when you consider the fact that many entities like life insurance companies made investments in private equity. And if private equity is defaulting on some of those loans, it can trickle down to life insurance companies. And that becomes a serious problem for insurers. Or think about mortgages. Now, this isn't like 2008 when people were giving out mortgages to people with no income and no jobs. These were people that bought homes that had great credit scores and were earning pretty high salaries, but their jobs have been rendered useless. And because of that, mortgages in tech centers like San Francisco, Seattle, and Austin, the value of those homes could start to crater, which again, as we saw in 2008, could push down further dominoes, the end result being that credit markets could tighten writ large. Now, this represented a very scary scenario, and when the market opened on Monday, less than 24 hours after this report dropped, we saw a lot of the stocks that we're talking about down high single digits, low double digits, and many entities, including government officials and even Reuters, talked about how this Citrini report could be, it's impossible to know for sure, but could be part of why this crash was happening. So the question becomes, how much of this should we believe, and what should we do to avoid the worst of it as investors? Well, I want to tell you right now, those are the exact questions we are focusing on in my community, Stock Investing Mentor. Now, Stock Investing Mentor has 3 parts. The first is 1 hour of live weekly sessions that are recorded on Thursday afternoons, where I teach one tidbit and we discuss topics such as this. You also get full access to my portfolio in real life, along with a video explanation of every move that I make in my portfolio, and 24/7 access to our private online investing community. If you're interested in becoming a member, simply click the top link in the show notes below and you'll get 10% off if you register by the end of Friday afternoon. But to get back to what should we believe moving forward, that is an issue for another video entirely, and we're still trying to figure that out. But I do want to leave you with this, because I do believe that it's important to remember the words, sage words, of one of my former colleagues and someone who I think is a great thinker right now, Morgan Housel. And he's talked a lot about the paradox of pessimism and optimism. Obviously, this Citrini report is meant as a warning, not saying that this is a foregone conclusion. But we need to remember a couple things about pessimism. As Morgan says, optimism sounds like a sales pitch, and pessimism sounds like someone trying to help you. So we tend to give more weight to pessimism. Of course, evolutionarily, this makes sense because we want to avoid ruin. On popularity, pessimism is intellectually seductive in a way optimism only wishes it could be. Look at those 25 million views that Citrini got through no fault of their own because it's pessimistic. On perspective, hearing that the world is going to hell is more interesting than forecasting that things will gradually get better over time. That is clearly true. And on attention, bad news gets more attention than good news because pessimism is seductive and feels more urgent than optimism. Of course, all of that is true. And yet, at long-term mindset, we are focused on the long term. So I want to focus on the key thing that Morgan says, which is that pessimists often extrapolate present trends without accounting for how the markets adapt, which is why in Stock Investing Mentor, we are focused on how the market could adapt moving forward. And I want to leave you with this. What Morgan says is the best financial plan is to save like a pessimist and invest like an optimist. So this Citrini report really took the market by storm over the weekend, and I wanted to provide a quick primer on everything it covered and a mindset for how to think about it moving forward. What did you think of the report? Let us know in the comments section below, and don't forget to hit subscribe as we talk about how this unfolds in the coming days, weeks, and months ahead. Until then, Brian, out.